Hi, this is just a quick video just to explain what the ins and outs of the trade we did on the 4th of June, which was the crude oil risk reversal. There's been a number of questions that have come in from people, kind of, why have you not lost money? Surely if you'd have just shorted, you'd have made more money, well, obviously. You must have just overhedged to make money, used up a lot of margin. So I'm going to try and explain how we can eradicate a number of things, and also why we made money. So the trade itself took place around 52.80 was where we got in and hedged it, and we got out down at kind of 51.60, 65 area. So you'd arguably, in a long risk reversal position, as puts are becoming more bid, but I'll explain that in a second, you would have expected us to have lost money. But that's good. Let's just work through some stuff. So first of all, it's kind of, I'm going to excuse the basics if people think this is too basic, but we've got along the x-axis here is the number of the strikes and the volatility. So in the Black-Scholes model, what you would normally have before the term skew came into play, there would be an equal amount of volatility for every single strike. So what we see as the vol path of each different month. So this is just 1 month. So let's say in the case of this, we're just saying August, right? And the volatility for a 50 strike in crude oil or a 70 strike would have all been the same, would have been an arbitrary number, let's say 33%, okay? And that's it. When the model first came out in the 70s, that's all that happened. It was one flat line, and that was it. Well, people started to realize that the most known space would have been the at the money, assuming, let's say, the current prices, the futures prices right here. And they started to actually change to say that actually I want to be paid or recompensed more for strikes that are further out the money. And hence what was born is what we call now the skew. And some skew, so if I was going to redraw this for the mini, you tend to find its skew has a little tiny smile here. If this is the at the money right here, and the puts always become bid. So the further the mini falls, the more people want compensating for the put side. So it's more of a smirk than a smile. If you look at something like corn, it's totally the opposite. So here's the at the money. Corns tend to go down here and then go up that way. Same with gold. Gold has a similar upside. So and then you look at kind of currencies, they're fairly well balanced. They look more like kind of a dinner plate rather than anything else, if that's the at the money. But changing the volatility of the individual strike, so the volatility of the 50 strike is different to the volatility of the 51 strike. This is how now market making models and pricing models have the capability to move along a skew path, which they're basically saying, I want compensating more. So when most people are kind of quoting, they would, if this was the path here, we cut the wings off. So I don't quote anything crazy and short today. So we know as cut the wings off. So if here's the at the money, all the quoting that happens is done here and here and here to here. So anything ridiculously out the money up here, like a $15 put in crude oil all the way down here, I'm just not interested in quoting that. If it's only a month away, it's going to be cabinet anyway, which means the minimum price. So just when the Black-Scholes model was first derived, there was no mechanism for what we call now skew. So what people now, the value of a put at 20 delta would have been exactly the same price as the value of a call at 20 delta. It was this flat line, and that's it. So if I can erase what I've drawn there. So just to go back over, it would have just been flat. So if you're right here, it would have said, I want a 4,000 call in the E-mini. Yep, the volatility would be there because it's also the same if you want a 2,000 call in the mini. Okay, and someone realized, wow, there's some fantastic arbitrage opportunity in this, and slowly people were manually lifting the price, and then the machines got involved, and now, if you're looking at the mini, the skew, if the out the money's here, the skew looks something like that, and you've got call suppression as people are selling calls to cover their existing long positions. Okay, Skew is born from people needing to reprice an entity. All right. Okay. So if we go on to the next slide. So this trade. So what you're looking at here is the 25 delta risk reversal. So that is saying at any moment in time, whichever option in the option ladder is 25 deltas. So hold on a second, I'll show you. So this is just showing the July. I've cut everything else off while I pause the recording. So 25 delta puts are worth $1.12. 25 delta calls are worth 85 cents. Now, quite quickly, you can see that the equivalent a 25 delta, you're saying is that something has a 25% chance of finishing in the money. All right, let's just keep it as simple as that. And what they're saying in this is that the value of puts is over and above the equivalent value of a call. So $1.12 against 85 cents is leaving you 27 cents difference. In a percentage terms, you're looking right here. The percentage terms is this point just here. Hold on, show it. So in this chart right here, it's saying that on a volatility basis, puts are forcing the call minus put to be more expensive by circa 6%. Okay. That's all the risk reversal is saying. It's saying, if I went back to the chart here, if I can actually bring that back up, what's going on? Oh, I'm sorry. I'll just get rid of that stupid thing. If I went back to the chart here and bought a 25 delta put here, it's going to cost me $1.12, and the same here, 85 cents. This is the arbitrary difference in percentage terms of volatility. That's what that's doing. So if we look at this, as a volatility, hold on one second. Before we do dip onto the next slide, I just wanted to show that obviously this is assuming a continual 25 delta. So we need to remember that an option at any one point in time is changing as the price changes. So if the price of the underlying drops dramatically, the puts that were 25 delta may be up to, say, 35 delta, and the calls that were 25 delta maybe out to 10 delta or 15 delta. So it's that moment in time, and we use a hedging mechanism to maintain that polarity across everything, which I'll show you in a moment. Okay, so we just nip onto the next slide here. So these are crude oil August skews. The blue line is right in this moment as of the settle. The green line is the third. The yellow line is the fifth. And the orange line, whatever you want to call it, orange or red, is the sixth. So this is kind of the moment in time of the trade occurring. So if I just move this on to edit so I can edit the screen. So where were we? We were into the 48s on the downside. Okay, and we were into the 59s on the upside. So first thing that should be telling you is when we kind of got in here, we sold a put. Okay, so we sold a put. Excuse my terrible writing of all this. And we bought a call here. Okay. Now, the first thing you're going to notice is that put had a volatility of about 49%, and we have seen that fall over the 5 days to a volatility of circa 42%. So it's about here. We got out. The reason I put that line up is that's the day we got out. So we've got a variance here. Of that option itself of 7%. Okay. And here we bought this at circa 38%, and it fell to about 37%, 36%. Okay. So already you'll see here the variable is 2%. Okay. Got it. I'm going to have to get a better way of drawing these things on, but it helps. So first of all, we've made 7% there. We've lost 5% there. So if we just quickly move back to the... let me remove the edit off here so I can click back. Right. Okay, so put the edit back on here. And you'll see where we got in about 10%. and we were saying that we had a variable of 5%, and we're up. It's up. We got out about, but I think it was about here actually. So we've gone just over. I think it was 11%, and it's now down to say 7%. Okay, so we didn't actually capture it all. It's further up now. I mean, it's moved from just about 11% to nearly 6%. So there's been a wider move. But what we're looking at here is that move here. This is the difference of price change between these markers. Again, if I really highlight them where our strikes were, and moving across here, 59. Okay, so you can already see the distance that's fallen is greater than the distance that's fallen in that environment. The skew itself has changed, but what's happened is the put skew, this side, if this is the at the money's down the middle, has fallen much faster than the calls. That's what answers the question. People say, "Oh, it went down anyway. How have you made money?" Well, the speed of the selling in the puts outpaced the speed of the selling in the calls. Okay, so if we look at this from a delta perspective, so the previous chart is volatility by strike, so each of the strikes. If we look at this by delta, so this is the same skew but remaining a fixed delta. So what that's doing here is, rather than this being the 48 strike, which we're trying to keep here, we sold here, and we bought here, and we bought here, and we sold here, assuming we've done these two. So you can already see, the naked eye can see the difference between the two here. All right, that's where the 5% of the original transactions come from. Now, this is not. People are saying kind of, why would you hold the? It's not this. This is. We have hedged the trade. The trade's hedged straight away because we want to remain delta neutral. And the reason we picked the August contract to do this and not something shorter like the July going off is because the further out you go, you get less movement in the risk reversal, but you also have to do less hedging. So the less days you have left on the contract, the more messing around with hedging you need to keep doing. We wanted to kind of minimize that for all the customers. But you'll see here it's when you've got a 25 delta, which we look here. This would have moved to the live price, but at the time of the transaction, it was a 25 delta here and a 25 delta here. And then the 225 deltas, a short put and a long call, leave you needing to hedge 50 deltas of outrights to remain delta neutral. So that's what this pattern looks like here. So you need in a way, the confusion is the blue line. Okay, the confusion is the blue line. In reality, if we'd have moved down dramatically on that, we would actually carried on making more because the upside gain of puts wouldn't have outpaced what was falling on here. And if we had have gone up, the selling on the put side would have again. I mean, the ideal solution of a risk reversal is the underlying goes back up. What we had was the underlying went back down, and we had compression on the put side. So we were short the hedge from here, and the market went down, and the puts got compressed. So it was a perfect storm of profitability. In reality, what should happen is the market should go back up. The puts collapse further, but you've lost the money on the futures contracts that you've hedged short, and that's it doesn't always pay off as quickly as what happened. In and out in 3 days like that was unheard of. But we're not interested in the underlying movement. We want those puts to be weakened because we're delta neutral. And the key here is to remain delta neutral at all times. I think the first hedging cycle that required was at 44 or 45, which you can see the curve off here. As we start then around 45, 46 to see the profitability starts to fall in as to what that curve would be. And believe, for every 10 lots people had, they needed to sell an extra one. And then on the upside here, we needed to buy an extra one above 66. So this is just kind of giving you that outline of the hedging mechanism. Now, if you ever model this up with kind of sub 20 days, sub 10 days on them, they're horrific because you're hedging all the time, and that's the danger. You start having to hedge like you're short a straddle. Whereas the objective is of a risk reversal slightly longer date is that you can minimize the amount of hedging and just benefit from being delta neutral, but that puts or that call, whichever side you are, weakening at a greater pace. So that was it, really. Well, there was another question, which is it uses up a lot of margin. Yes, I'm aware that a number of people have said that it uses up a lot of margin. So I will just very quickly show you what we're going to be doing. And we will do this as a 1:2 ratios to make it easy. Okay, so yeah, as I said, we'll be doing this as 1:2 ratios. So I'm just going to make this a little bit easier for everyone if we just go back onto this. Right, okay. So this is the risk reversal. Quite simply, you've sold the put, bought the call. So let's just change this now to 2 1:2 ratios. Okay, so all we need to do is add an extra call, take an extra put off. So this is the same at the moment, yeah, long ratios, long risk reversal. But what we're going to do here is we're going to at the money, we're going to sell a call and we're going to buy a put, okay? Which makes it a custom spread. Exactly, and you watch over here, okay? Nothing should change for the structure. There you go, okay? The way the graph draws, it's added some more strikes. But what we've done here is we've just created the risk reversal exactly the same, but it's a little bit more of a kind of purist way. Actually, it's got a future in it which we don't need. Let's get rid of that. There you go. Now it looks identical. I wonder why it was slightly off on one side. And it looks exactly. This is an exact same as a risk reversal, okay? But you're basically creating the short futures contract synthetic, the half of futures contract right here in the middle by selling a call and buying a put. Now, when you put this through as two 1:2s, you would do the first 1:2 selling that call and then buying those calls, and then you'd come back and you could actually give it a little bit more time. It's less stressful putting them on. You do the 1:2 here on the put side as well. Okay, builds exactly the same thing and uses a lot less margin. So that all of them will be putting out. Doing it this way. So the reasons I haven't put it that way is that's kind of my fault probably, is most market makers are always looking for deltas. So when someone comes in for asking for a normal risk reversal, I'm happy to hedge in the futures contracts because I want to be hedging there. Whereas putting more of a professional trader mindset, you want to be doing it in the most cost effective way, and that's this way. Also, you're going to be trading less. You're not so worried about the deltas. This is more of a purist way of doing it because we're using pure options contracts to create a risk reversal. So we've got a lot more swing exposure of the Vega, which is what we want. And I guess as well, I'd always come from a kind of lowest cost of transaction. If you actually think it through here, so to get on usually one risk reversal for me, it's you'd say you'd sell one put, you'd buy one call, and you'd need to do half of futures contract. So that's the lowest cost per transaction. It's 2.5 entities hitting the CME, whereas here we're now talking about 6 entities having to hit the CME. So I guess I come at it from a cost perspective, but I do understand people are concerned about the amount of margin it uses up, and this is a lot less. It doesn't change anything else, as you can see from the diagram here. It's exactly the same payoff, and there's the same hedging mechanism. You might be able to get a little bit, if you move away from the center of the strikes, you might get some compression. So it could pay off a little bit better, but the most important thing is helping you guys get the trade on at the lowest possible margin cost, and also let people kind of understand it. Also, this is a kind of an easier, safer way. So when you've got the first 1:2 on, by default you've got a very low delta position. So you could, if the underline's rallied a little bit here and you want to get the first leg on and get the next leg on pullback, you could do that and it's safer. I would never ever recommend anybody doing that on a naked risk reversal. So that's that. I hope that's explained all of the questions. Let's just quickly see. Where are we? Why have we not lost money? You've done that. Why did we sell a put? Went out. Where we've explained that. Surely, yeah. I mean, this one. I mean, yeah. I mean, this great. Yeah, you could have just sold crude oil. You could have just got lucky, rolled the dice, sold crude oil here, it gone off and bought it back, and you're back on the beach. But the reality is our risk profile was tiny, and our reward was just huge. So that's the reason we did that. Were we overhedged? No, we're completely delta neutral. The whole idea of this is to remain delta neutral. I have a personal view where I think that if the market's trending lower, arguably here in crude, it's trending lower. When you're getting into a risk reversal spin, you're looking for some basing of that risk reversal. Would you overhedge slightly in the direction of the trend? Yeah, arguably you could back test that and it probably paid off. But we are remaining as pure as possible to the strategy and not getting involved. And when we move to doing this as 2 1x2s, obviously we'll put out both in the trading information, so you can do it as a normal risk reversal if you've got plenty of margin. And I'll do it as 2 1x2s as well. So I mean, I prefer doing it as the way we have been. But obviously it's up to everybody. Cool. All right. Thank you very much. And I hope this helps. And we'll be going through all of this kind of stuff in great detail, and understanding all the journey along the hedge path as well. In the 26th to the 30th sessions, we'll be deeply assessing every single point. All right. Cheers. Thank you. Bye.